Imagine an impenetrable vault. Like, just picture it in your head.
Okay, I'm picturing it.
Right. So inside this vault, there's no gold, there are no stacks of $100 bills, and there are literally no physical objects of any kind.
Which is pretty hard to wrap your head around, honestly.
It is. And in fact, the vault itself doesn't physically exist anywhere on Earth. Yet this invisible structure currently protects like over $1 trillion of human wealth.
Yeah, $1 trillion. It's staggering.
And it does all of this without a single security guard, without a CEO, and without a bank manager. I mean, you just look at your smartphone, you see a ticker symbol, and you just sort of accept it as part of our modern financial reality.
We completely take it for granted. We love the sleek interface of our financial apps, but we are completely blind to the nuts and bolts operating underneath them.
Exactly. People want the financial result without having to endure the technical complexity. Which brings us to the mission for today's deep dive. Because if there is one thing in the modern world that is treated like the ultimate black box, it's Bitcoin.
Oh, without a doubt. The ultimate black box.
You constantly hear about it. I mean, you see it in the news every single day. It's all over your social media feeds. Politicians are debating it. And, your friends are probably asking you if they should buy it.
But if you actually stop and ask someone, okay, but do you actually understand the machine underneath it? Most people just draw a total blank.
They really do. So our goal today is to rip the lid off that black box. We have this incredibly comprehensive source manuscript in front of us, and we're going to do a complete front-to-back analysis of Bitcoin.
Right, we're talking about its history, its foundations, how it mechanically works under the hood, which is fascinating, by the way.
Oh, absolutely. We'll get into who actually owns it, how the market infrastructure operates, and the exact mathematics of its supply. So whether you are prepping for a meeting, catching up on the financial landscape, or you're just insanely curious, we are going to give you the ultimate shortcut to being truly well-informed on this topic.
Yeah, we are focusing purely on the how and the why today.
Yeah.
I mean, the daily price fluctuations make the headlines sure, but the underlying mental model of how the system actually processes truth, that's what survives the news cycle.
Okay, let's unpack this. Let's start right at the foundation. Because according to our sources, the single biggest mistake people make when they try to wrap their heads around Bitcoin is fundamentally miscategorizing what it actually is.
Yes. They try to map it onto something they already know. And if you want to understand this system, you really have to begin by unlearning those mappings.
Right.
Bitcoin is not best understood as an app on your phone. It's not a stock. It's not a tech company located in Silicon Valley. And it is certainly not just like a magical digital coin floating out there in the ether.
I think people literally picture a physical vault somewhere, holding shiny golden coins with the B stamped on them. Or maybe like a server room controlled by a board of directors in suits.
Exactly. And that's just not it. The baseline reality is this. Bitcoin is a monetary network with a native asset. And the confusion almost always stems from people collapsing several entirely different concepts into that one single word.
Meaning when people say Bitcoin, they're actually talking about different things.
Yeah, exactly. Sometimes when people say Bitcoin, they mean the asset itself, the thing measured in BTC. Other times, they mean the actual payment network that transmits the value.
Ah.
And sometimes they mean the entire protocol. The software rules, the users, the miners, the nodes, the exchanges, the whole sprawling ecosystem. You really cannot become fluent in this topic until you learn to keep those layers separate in your mind.
I want to separate them right now then, because the manuscript breaks this down into 3 crucial layers that we absolutely have to keep distinct. So we have the ledger, the asset, and the settlement system.
Right.
Walk us through those, starting with the ledger, because when I hear the word ledger, my brain immediately just pictures a giant Excel spreadsheet shared on Google Drive where someone is just typing in numbers.
That is a very common starting point, but it leads to a massive misunderstanding of the security model. At the base layer, yes, Bitcoin is a distributed ledger. But it is not merely a shared spreadsheet where an administrator can just edit a cell.
Okay.
The deeper truth is that it's a ledger where the rights to update it are strictly constrained by cryptography, by massive economic competition, and by rigid consensus rules.
Meaning nobody can just open the file, find my name, and change my balance from 10 to 0 just because they don't like me.
Exactly. No single entity gets to rewrite balances just because they have authority or administrative privileges or political power. To change ownership on this ledger, you must possess valid cryptographic signatures.
Right. The math has to check out.
And to add new pages to this ledger, what the protocol actually calls blocks, you have to satisfy an enormous computational requirement known as proof of work. Plus, every single participant on the network independently verifies that all the rules were followed to the letter.
Oh, wow. So there's no trust involved at all.
None. That combination of unforgeable cryptography and decentralized consensus is what makes this ledger fundamentally different from, say, a database sitting on a private server at JP Morgan or Bank of America.
So that indestructible, unforgeable record is the ledger. Then there's the second layer, the asset itself, the actual Bitcoin with a lowercase b. And here is where people get tripped up comparing it to traditional investments like Apple or Tesla stock.
Yeah, people really struggle with this. A Bitcoin is not a physical object, but it's also not an IOU from a corporation. It does not represent a claim on corporate profits.
Right.
It's not a promise of redemption, and it absolutely does not give you a legal right to future cash flows.
So what actually is it? I mean, if I own one, what do I actually own?
You own the protocol's native scarce unit. It is simply the specific digital unit that the network recognizes as spendable value when the correct mathematical conditions are met.
That sounds, it sounds a lot more like a commodity.
Exactly. Serious macroeconomic analysts compare Bitcoin much more to a commodity, money-like physical gold than to an equity. There is no central issuer out there promising performance or guaranteeing its value. There is only a rigid mathematical rule system governing how it's supplied and how it's transferred.
Which brings us to the third piece of the puzzle, right? The settlement system.
Yes. Bitcoin isn't merely a speculative asset to trade on an app. It is a system for finalizing ownership without relying on a central operator. And this distinction is critical.
How so?
Well, it doesn't necessarily mean every single transfer is going to be instantly fast or cheaper than swiping a Visa card at a coffee shop. What it means is that the final source of truth, the ultimate irreversible settlement of who owns what, exists entirely outside of a bank.
Okay.
It exists outside of a corporate payment processor and outside of a state-controlled financial ledger. For some people, that independence is just a neat technical feature. But for others, it is the entire moral and economic point of the system's existence.
I love how the source text frames this overarching concept. It suggests a really useful way to think about Bitcoin is as a machine built to create digital scarcity and then transfer that scarcity with credible finality.
That's a great summary.
But before we get into the gears of how that machine runs, I have to ask, why build this machine at all? What was the actual real-world problem that required this incredibly complex, energy-intensive solution?
To understand the why, we have to go back to a classic, notoriously unsolved problem in computer science and cryptography. It's known as the double spending problem.
Right, and I think everyone intuitively understands this with regular computer files. Like, if I have an MP3 file of a song or a PDF document, I can email it to you, but I still have a perfect copy sitting on my own hard drive.
Exactly.
I can copy that same file a million times perfectly for zero cost.
Because digital objects, by their very nature, are infinitely and perfectly replicable. So if a purely digital token can be perfectly copied, it is completely useless as money.
Yeah, that makes sense.
Think about it. How do you prevent someone from taking a digital dollar and spending that exact same dollar twice or 1,000 times at different stores? Historically, for decades, the only way to solve the double spending problem was to use a central ledger.
You needed a referee.
A trusted intermediary. A commercial bank keeps the authoritative record. A credit card network keeps the authoritative record. PayPal keeps the record. You, as the user, have to trust that specific institution to honestly maintain the state of the ledger.
You trust them to say which balances are real, who spent what, and who has what left.
Precisely. But the creator of Bitcoin, this pseudonymous figure, Satoshi Nakamoto, looked at that requirement for trust and said, what if we could do this without the referee at all?
And that was the breakthrough question that basically launched the entire industry. Could the internet support a native form of money where the authoritative record is maintained without having to trust a single central institution?
Yes, and that meant solving not just the double spending problem, but the much broader problem of distributed agreement in a highly adversarial environment.
Adversarial meaning people are actively trying to cheat?
Exactly. How do you get tens of thousands of different computers scattered around the world, run by people who don't know each other, to converge on one single mathematically pure transaction history? especially when you have to assume that some of those computers are actively trying to lie or steal the funds.
Building a system that constantly arrives at the truth without a central box dictating what the truth is, that is a staggering engineering puzzle. And the timing of when this puzzle was actually solved is almost too cinematic to believe.
The timing is incredible.
We really cannot ignore the historical context here. Satoshi publishes the Bitcoin white paper in October 2008. The entire global financial system is essentially on fire. Lehman Brothers collapses, markets are crashing, governments are printing trillions to plug holes in bank balance sheets.
And then the Genesis block, the very first block of Bitcoin data ever created in January 2009, contains a hidden message.
Wait, really? What was it?
Embedded permanently in the raw hexadecimal code of that first block is a headline from the Times of London. Chancellor on brink of second bailout for banks.
Wow, that actually gives me chills.
It's powerful. People still debate the exact intent of that message, though. Was it merely a timestamp? A way to prove the block was created on that specific day? Like a hostage holding up today's newspaper in a photograph?
Or was it a pointed, highly political statement about the fundamental fragility and unfairness of the legacy banking system?
Most likely it was both. What truly matters is the historical resonance. Bitcoin emerged at the exact moment when public trust in financial institutions and central banking discretion and in the elite stewardship of the economy was completely falling apart.
But our sources are really careful to point out that this wasn't just some angry anti-bank revenge project thrown together overnight in a garage. It was actually the culmination of decades of prior work and failed experiments.
Oh, absolutely. It synthesized several pre-existing intellectual currents. You had the cypherpunk tradition. These were brilliant activists and cryptographers in the 1990s who believed heavily in privacy, cryptographic autonomy, and reducing human reliance on centralized power.
Right.
And there were many failed attempts at digital cash before Bitcoin. Systems with names like DigiCash, Hashcash, B-Money, and BitGold.
Let's talk about Hashcash for a second, because I think it perfectly illustrates what Satoshi actually invented. Hashcash was created by Adam back in the late 90s, but not as money, right? It was a way to stop email spam.
Yes, the idea was brilliant. To send an email, your computer had to do a tiny bit of computational work, solving a quick math puzzle that took maybe 2 seconds.
Okay.
For a normal person sending 5 emails a day, 2 seconds of background processing is totally unnoticeable. But for a spammer trying to send 10 million emails at once, it would require massive, economically ruinous amounts of computing power. It's essentially computational postage.
So the concept of proof of work, forcing a computer to burn real energy to prove it did something already existed. But Hashcash failed as a currency.
It failed as a currency because while it created digital scarcity, it lacked a decentralized consensus mechanism. If I gave you a Hashcash token, how do we prove to the rest of the world that I didn't also give that exact same token to someone else without asking a central server to check?
The double spend problem again.
Exactly. Satoshi took the proof-of-work concept from Hashcash, combined it with public key cryptography, and introduced the blockchain data structure to solve the consensus problem. Bitcoin was the unified design that finally achieved fixed terminal supply, open verification, permissionless participation, and no central issuer.
Basically building a form of money where the rules don't suddenly change just because a politician or a powerful bank decides they need to print more. Which brings us to the elephant in the room.
True.
Satoshi Nakamoto.
Yeah.
The media is absolutely obsessed with trying to unmask this person or group. Like, who is the real Satoshi? But the source text makes a really interesting pivot here. It essentially argues that focusing on the mystery identity is missing the entire architectural point.
It is an enormous distraction. The mature way to analyze the Satoshi question is to rigidly separate the actual cryptographic evidence from the breathless media narrative.
Right.
The evidence is simply that someone or a group of people using that pseudonym wrote the white paper, wrote the first code, mined the early blocks, and corresponded with early developers like Hal Finney.
Hal Finney being the cryptographer who famously received the very first actual Bitcoin transaction from Satoshi.
Correct. Satoshi guided the project through its incredibly fragile infancy and then systematically handed over control of the code repository and vanished entirely.
Meanwhile, the narrative is this endless stream of documentary specials trying to track down some guy in California or an eccentric programmer in Australia or theorizing it was the CIA.
And all of that misses the point. The real achievement wasn't the mystery. It was the architecture itself. Think about what Satoshi didn't do. Satoshi didn't launch a startup. There was no CEO. There was no venture capital seed round, no marketing department, no foundation.
There was no pre-mine either, right?
Yeah.
Where the creator secretly allocated a massive percentage of the supply to themselves before letting the public in.
Exactly. And here is the most crucial point the sources emphasize. The disappearance of the founder is widely considered to be one of the most important decentralizing events in Bitcoin's entire history.
Because if there is a known founder, there is a target. There's a single point of failure that can be pressured.
If Satoshi had stuck around, Satoshi would inevitably be the de facto monarch of the protocol. When technical debates arose, people would look to Satoshi to settle them. When governments wanted to regulate the network or freeze an account, they would subpoena Satoshi and order a change to the code.
Okay.
By vanishing, the founder ensured that the protocol belonged entirely to the network of users. It was the ultimate act of letting the machine run purely on its own mathematics.
Okay, that sets the stage brilliantly. We know why it was built to solve the double spending problem without a referee during a time of massive institutional distrust. We know the architecture was the real genius, not the mysterious identity.
Right.
But understanding why it was built is only half the battle. If there is no central database at a bank, and there's no physical metal coin in my pocket, how do you actually hold this thing? How do you spend it? This leads us directly into looking under the hood at the mechanics of ownership. Let's get into the machine itself.
The mechanics ownership are where the paradigm shift really happens for most people.
People use this term digital wallet all the time, and I think the analogy really messes with people's heads. They think a Bitcoin wallet holds digital coins exactly the way a physical leather wallet in your pocket holds paper dollar bills. But the manuscript is very explicit about correcting this misconception.
It is perhaps the most fundamental operational misunderstanding in the entire space. A Bitcoin wallet does not store coins. It stores keys.
Keys, not coins.
The coins, the balances, the transaction records, those exist solely on the distributed public ledger of the blockchain. They are public data replicated across thousands of computers worldwide.
So what is the wallet then?
Your wallet is essentially a cryptographic keychain. It holds the mathematical keys that prove you have the authority to move the assets recorded on that public ledger.
Break down the difference between public keys and private keys for us, because this is where the cryptography actually touches the daily user experience.
Think of a public key like your bank account number or an email address. You can give it to anyone. You can post it on a public billboard. It's perfectly safe to share. It is simply the destination address where people can route funds to you.
Okay, so what about the private key?
A private key, on the other hand, is the mathematical PIN code to your account or the password to your email. It is a piece of secret mathematical information that allows the holder to generate a digital signature, authorizing the spending of the Bitcoin associated with that public address.
So if someone gets my public key, they can pay me. But if someone gets my private key, they are me, cryptographically speaking, and they can take absolutely everything.
Exactly. The network doesn't know your name, it doesn't check your passport, and it has no fraud department. It only checks the math. If the private key produces a mathematically valid signature for a transaction, the network processes it, period.
Okay, here is where it gets really granular, and the source text spends a lot of time on this concept. It's called the UTXO model, unspent transaction outputs. The text emphasizes that Bitcoin does not work like a normal bank balance at all.
What's fascinating here is how alien this accounting method is compared to what we are used to. When you log into your traditional bank app, you see a single number, balance, $100. If you spend $10, the bank's centralized database simply deducts 10 and updates that single cell in their spreadsheet to, say, $90.
But Bitcoin doesn't do that.
But Bitcoin does not use account balances that dial up and down. It tracks discrete, distinct chunks of spendable value. These are the UTXOs.
Let me try an analogy here to see if I'm tracking this, because this literally blew my mind when I read it.
Go for it.
Let's say I have a physical $20 bill in my wallet. I go to a coffee shop and buy a $5 coffee. I don't hand the cashier my $20 bill and ask them to just pull out a Sharpie, cross out the 20, and write a 15 on it.
No, of course not. You hand over the physical note to be processed.
I hand over the entire $20 bill. That specific bill is consumed by the transaction. The cashier takes it, puts it in the register, and then hands me back a brand new $5 coffee and a brand new $10 bill and a $5 bill as my change. That's exactly how Bitcoin works, isn't it?
That is a perfect analogy. When you receive Bitcoin, you are actually receiving one or more of these distinct, unspent outputs mathematically locked to your public key.
Okay.
When you go to spend it, you don't just shave a little bit of digital value off the top of an account. You consume the entire existing output. the metaphorical $20 bill, and the transaction destroys it.
It actually destroys it.
Yes.
Yeah.
In its place, the transaction creates brand new outputs. One output goes to the recipient, the $5 coffee, and the remainder comes back to a new address you control as change, minus a small network fee.
So when I open my Bitcoin wallet app on my phone and it simply says I have 1.5 BTC, it's kind of lying to me, or at least it's doing a massive amount of visual cleanup behind the scenes to make it look simple.
Your wallet software is absolutely aggregating the data for your convenience. Under the hood, that 1.5 BTC might actually be comprised of a 0.5 chunk you received last year, a 0.8 chunk you bought last month, and a 0.2 chunk of change from a previous transaction you made yesterday. Your wallet just finds all the UTXOs your keys can unlock, adds them up, and shows you a total.
Why design it this way? I mean, why not just use the simple bank account spreadsheet method? It seems incredibly complicated to constantly destroy and create these data chunks.
It sounds complicated to a human brain, but for a distributed network of computers, it is incredibly efficient and secure. Because every single transaction explicitly references previous specific outputs that are being destroyed and creates new outputs, it makes the entire history of money mathematically traceable.
And that physically prevents double spending.
Exactly. The nodes on the network can instantly look at a transaction and say, wait, that specific $20 bill output was already consumed in a block 3 days ago. Transaction rejected.
And this mechanical structure also fundamentally dictates how much you pay in transaction fees, right? Because the fees in Bitcoin are based on the data size of the transaction, not the dollar value being sent.
Yes, and this is a critical point of confusion for new users. If you want to send $1,000 and your wallet does it by sweeping up 500 tiny little UTXOs you received from micropayments over the last year, your transaction is going to be massive in terms of byte size.
Right, because you're referencing 500 different inputs.
Exactly.
Yeah.
It takes up a lot of space in the block, so you will pay a higher fee. Conversely, you could send $1 billion using a single massive UTXO. The data size is tiny, and the fee is practically nothing. You're paying for block space, not value transfer.
Okay, so a transaction is basically a mathematical message broadcast to the network saying, take this old chunk of value, verify my cryptographic signature to prove I own it, destroy it, and create these new chunks.
That's it in a nutshell.
But there's a little bit of programming logic involved here too, right? The scripting system. The text points out that Bitcoin's scripting language is deliberately limited.
Yes. Unlike Ethereum, which was designed years later to be a world computer, where you can write infinitely complex programs and smart contracts, Bitcoin's scripting language is intentionally narrow and dumb. It is what computer scientists call not Turing complete.
Turing complete being named after Alan Turing, meaning a system that can theoretically run any calculation, including endless loops or highly complex logic, if given enough time.
Precisely. Ethereum needs Turing completeness to run decentralized lending protocols or complex token exchanges. Bitcoin intentionally avoids it.
Why? Wouldn't you want it to be smarter?
That is not a bug. It is a vital security feature. By radically constraining what the scripts can do, you drastically reduce the attack surface.
Right.
A Turing-complete system can be tricked into running an infinite loop that crashes the network.
Yeah.
A typical Bitcoin script essentially just says, to spend these funds, provide a valid signature that matches this specific public key. Keep it simple, keep it verifiable, keep it unbreakable.
Okay, so my wallet creates this transaction, signs it with my private key, and broadcasts it into the network's waiting area, the mempool. But who actually approves it? Who are the judges in this system? This brings us to a really vital distinction between nodes and miners. I think most people assume miners run the whole show.
That is a massive misconception. People see images of giant mining warehouses and think miners are the bosses because they use all the energy and get all the new coins. But the true balance of power in the Bitcoin network is completely different. The nodes hold the ultimate power.
Define a node for us. Like, what does it actually look like?
A node is simply a computer running the Bitcoin core software. You, listening to this right now, could download the software for free and run a node on an old laptop or a cheap piece of hardware like a Raspberry Pi.
Just sitting on my desk.
Just sitting on your desk. These nodes receive blocks of transactions, and they independently verify every single rule. Does the math check out? Are the signatures valid? Has this UTXO already been spent? Is the inflation schedule correct?
They are the auditors.
Auditors who hold absolute veto power. What's fascinating here is that the nodes are entirely uncompromising. A mining corporation could spend $10 million in electricity to produce a new block of transactions. But if that miner tries to sneak in a transaction that breaks the rules, say, trying to print an extra 50 Bitcoin for themselves out of thin air, the thousands of cheap little nodes run by ordinary users around the world will look at that block, recognize it violates consensus, and instantly reject it.
Oh, wow. So the miner's $10 million is completely wasted.
Completely wasted. Consensus in Bitcoin isn't a democratic vote where 51% of people can change the rules. It is an emergent outcome of all these individual participants independently running the exact same mathematical rule set. Miners propose the history, but the network of nodes decides if that history is valid.
If the nodes are the judges and miners are the heavy machinery, why do the miners do all this backbreaking work? What is the incentive, and where do the actual new Bitcoins come from? Let's look at the engine of scarcity itself.
The engine is where the physical world meets the digital ledger.
I have this cartoon image in my head from years of reading bad tech articles. It's an image of a supercomputer sitting in a dark room solving complex math problems like Sudoku or advanced calculus. And when it finally solves the puzzle, a shiny digital coin pops out of the CD-ROM drive. The expert text totally dismantles this idea.
Yeah, that cartoon image misses the core purpose of the entire activity. Mining is not primarily about creating coins. Mining is primarily about block production and network security.
Okay.
The new coins that are minted are simply the economic compensation mechanism to pay the miners for providing that security.
How exactly does the mining secure the network?
Through the proof-of-work mechanism, utilizing a specific cryptographic hash function known as SHA-256, when a miner wants to take transactions from the mempool and add them as a new block to the ledger, they can't just slap the data on and call it a day.
They have to prove they did the work.
Right. They have to prove to the nodes that they expended real-world energy. They do this by taking the data in the block, adding a random number to it, and running it through this SHA-256 algorithm.
And the algorithm spits out a new, garbled string of numbers and letters.
A hash. And the network rules dictate that for a block to be considered valid, this resulting hash has to start with a certain number of zeros. It has to be below a specific target number.
But there's no mathematical shortcut to find that specific hash, right? You can't use an algebraic equation to solve for it.
No, it is a probabilistic brute force competition.
Yeah.
It is literally just guessing. Imagine a massive global lottery. The miners are generating trillions of hashes per second, just guessing random numbers as fast as their microchips allow, hoping to hit the jackpot hash that meets the network's requirements.
It sounds exhausting.
It is incredibly expensive and energy intensive to produce the winning hash, but, and this is the genius part, once a miner finally finds it, it takes any node on the network a fraction of a millisecond to verify that the math is correct.
So it's phenomenally hard to make, but instantly easy to check.
Because it requires so much raw energy to find that hash, it means an attacker who wants to rewrite the history of the ledger, say, to reverse a transaction they made yesterday, would have to outcompute the entire honest network.
They'd have to catch up and overtake everyone else.
They would have to redo the work for that block and every block that came after it faster than the rest of the world combined. The energy isn't wasted. The computation is the defense wall.
I have a major pushback here, and I know listeners are thinking the exact same thing. Technology gets exponentially faster all the time. What if tomorrow Amazon or Google or some massive sovereign nation just decides to plug in 1 million quantum supercomputers and they mine all the remaining Bitcoin instantly? Wouldn't the whole supply schedule just collapse?
That is exactly what would happen in a static system. But Bitcoin has what many consider to be its most brilliant engineering achievement, the difficulty adjustment.
How does that work?
The protocol is hard-coded to target an average of exactly 10 minutes to produce a block. That 10-minute interval is the heartbeat of the network. Every 2016 blocks, which takes roughly 2 weeks, the protocol automatically assesses how fast the recent blocks were produced.
So it's like an Olympic track event. If the runners suddenly start running twice as fast and finishing the race in 5 minutes instead of 10, the track automatically lengthens itself so the next race takes exactly 10 minutes again.
That is a fantastic way to visualize it. If a massive corporation plugged in 1 million supercomputers and blocks started coming in every 2 minutes, the protocol recalculates the math. It increases the difficulty target.
It demands more zeros.
Yes, it demands more zeros at the start of the hash. It makes the guessing game exponentially harder, the block time right back to that 10-minute average.
It's a self-correcting thermostat for the issuance schedule.
And it works in reverse, too. If the price crashes and miners turn off their machines because it's unprofitable, the blocks would come too slowly, so the difficulty adjusts downward, making it easier to find a block. This mechanical masterpiece ensures that no matter how much compute power enters or leaves the network, the issuance schedule of new Bitcoin remains perfectly protected and utterly predictable.
The hardware doing this guessing game isn't just a bunch of laptops anymore, though. The manuscript details the massive industrialization of mining, moving from basic CPUs to these things called ASICs.
Application-specific integrated circuits. In the early days, back in 2009 and 2010, you could mine Bitcoin on a standard laptop CPU. But as the fiat value of the network grew, the economic competition intensified.
People realized there was real money to be made.
Exactly. Hardware engineers realized they could build custom microchips, ASICs, that do absolutely nothing else in the world except compute SHA 256 hashes. They can't run a word processor, they can't open a web browser, but they compute hashes millions of times faster and more efficiently than a standard computer.
So the era of hobbyist mining in your basement is pretty much dead.
It is now a highly capitalized industrial commodity business. Miners scour the globe, seeking out the absolute cheapest possible electricity. They build massive data centers, they manage complex liquid cooling systems, and they operate at razor-thin margins.
Wow.
And because the variance of finding a block on your own is so high, a single machine might go decades without winning the lottery, miners pool their resources together into mining pools.
To share the rewards.
Right. They combine their hash power to act as one giant entity, and when the pool wins a block, they split the rewards proportionally based on how much hash power each participant contributed. It smooths out their revenue stream so they can actually run a predictable business.
That is the engine running the security. Let's look at the actual monetary policy that is hard-coded into this engine, specifically the famous 21 million cap. Walk us through the math of how new coins actually enter circulation.
The monetary policy is perfectly rigid, which is a complete anomaly in the financial world. Every time a miner successfully produces a valid block, they are permitted to include a special transaction at the very top of the block, called the Coinbase transaction.
Okay.
This transaction awards them brand new, newly minted Bitcoin out of thin air.
This is the block subsidy.
Yes. When the network launched in 2009, that reward was 50 Bitcoins per block. Every 10 minutes, 50 new coins entered circulation. But the protocol dictates that exactly every 210,000 blocks, which, thanks to the difficulty adjustment, takes roughly 4 years, that reward is cut in half.
The halving.
The halving. So it went from 50 down to 25 in 2012, then 12.5, then 6.25. And as of the 2024 halving, the reward is now just 3.125 Bitcoins per block.
The supply growth is completely transparent and it is constantly declining.
If you extrapolate that geometric halving schedule forward, you get an asymptotic curve that approaches exactly 21 million coins. That is the absolute unchangeable hard cap.
This is what macro investors mean when they call Bitcoin hard money.
In fiat currency systems, dollars, euros, yen, the future supply is completely dependent on human policy discretion. Central banks hold closed-door meetings to decide if they need to print a few trillion more to stimulate the economy or bail out an over-leveraged bank.
With Bitcoin, the exact issuance path is known decades in advance.
There is no central committee to lobby. It is mathematically enforced scarcity.
The source material makes a really crucial point here that I think completely changes the math for investors. The 21 million cap is the nominal supply, but the effective spendable supply is actually significantly lower because people lose their coins all the time.
The tragedy of lost coins. Because ownership relies entirely on cryptographic keys, if you lose your private key or your seed phrase and you don't have a backup, those coins are gone.
Forever.
Forever. The network doesn't have a customer service desk you can call to verify your identity and reset your password.
We've all read the stories about people digging through landfills trying to find a hard drive with hundreds of millions of dollars on it.
Exactly. Discarded hardware, lost paper backups, people passing away without leaving inheritance plans for their digital assets. All of these events effectively destroy supply. The coins still sit there visible on the public ledger, but without the private key to generate a signature, they can never ever be moved. They become economically inert forever.
The pie is 21 million slices, but a huge chunk of those slices have already fallen on the floor and can never be eaten.
What's fascinating from a data analysis perspective is that looking purely at the blockchain, you cannot cryptographically distinguish between a lost coin and a coin that is just being held in very deep, long-term cold storage by a patient investor.
So we just have to guess.
All we can do is look at on-chain heuristics like coins that haven't moved in 10 years and estimate. But the consensus is that millions of coins are likely gone forever. It means the true liquid supply fighting for fiat capital is incredibly tight.
Because of the halving schedule continually slicing the reward, when does the last fraction of a Bitcoin actually get mined?
The tail of issuance stretches incredibly far out into the future. The vast majority of supply was mined in the first decade. The remainder arrives slower and slower. The final fractions of a single Bitcoin won't be mathematically mined until roughly the year 2140.
2140, wow. We now have this perfectly predictable, mathematically constrained machine defended by an impenetrable wall of encrypted energy that issues digital scarcity into the world. But here's the multi-trillion-dollar question. Scarcity alone does not equal value.
Right.
I could draw a weird little doodle on a napkin right now. It would be perfectly scarce. There's only one exactly like it in the universe, but it's essentially worthless. Why is anyone willing to pay actual hard-earned money for this digital asset that has no cash flow, no dividends, and no physical utility?
This is where the pure computer engineering meets human psychology and monetary economics.
People from traditional finance struggle with this so much. They look at a stock, they analyze the price-to-earnings ratio, they look at a corporate bond, they look at the yield. Bitcoin has none of that.
If you evaluate Bitcoin through the lens of a productive asset, a company generating quarterly profits or a farm producing wheat, it makes absolutely no sense. But if you evaluate it through the lens of monetary properties, it snaps into focus.
Okay.
Its value comes from a unique combination of features that humans have historically demanded from a monetary good.
Let's run through those properties. We already covered scarcity, the 21 million cap. But as I said with my napkin doodle, scarcity isn't enough. It seems to me that for this to work globally, it has to be incredibly easy to move. I can't attach a physical gold bar to an email and send it to Tokyo.
Building on that exact point, you have portability. You can move $1 billion of wealth across international borders in 10 minutes simply by memorizing a 12-word seed phrase in your head or carrying a tiny USB device.
Try doing that with gold.
Exactly. Try legally transporting $1 billion in gold bullion or physical cash across a sovereign border. It requires armored trucks, military-grade security, and massive logistical overhead. Then there is divisibility. One Bitcoin can be divided into 100 million smaller units called satoshis, making it highly granular for microtransactions.
It also has durability. It doesn't rust like iron. It doesn't rot like grain. And a rat can't eat it like a paper dollar bill.
And critically, it has permissionless neutrality. The base protocol doesn't care about your nationality, your politics, your religion, or your credit score. If you have a valid mathematical signature and pay the required fee, your transaction is processed.
Period.
Period. Finally, settlement finality. Once a transaction has enough block confirmations built on top of it, it is practically irreversible without expending an astronomical nation-state level of energy.
It's basically the ultimate bearer asset for the digital age.
If we connect this to the bigger picture, monetary goods are incredibly path-dependent. Gold became the global standard over thousands of years, not just because it's physically shiny, but through centuries of collective human consensus.
And Bitcoin.
Bitcoin has a massive, insurmountable first-mover advantage in the digital scarcity space. It has the brand recognition, the deepest liquidity, and the most battle-hardened security network. Over time, that network effect becomes completely reflexive. The more people believe it is the premier digital store of value, the more capital and infrastructure it attracts, which in turn reinforces and justifies that exact belief.
Here's where it gets really interesting, because the narrative around why people buy it seems to change depending on what year it is. People love to label things. They want to put Bitcoin in a neat little conceptual box. It's digital gold. No, it's an inflation hedge. No, it's just a high beta tech stock. The expert text points out that these single static labels are completely wrong.
They are far too simplistic for what is actually happening. The reality is that Bitcoin's correlation with other financial assets shifts dynamically over time, depending on the macroeconomic environment. It is a chameleon in the global financial markets.
Give me a concrete example of how it shifts.
Take the period during and immediately after 2020. During massive central bank liquidity injections and 0% interest rates, Bitcoin often traded with a very high positive correlation to risk assets, specifically the NASDAQ and tech equities.
Right, the whole everything rally.
When global fiat liquidity was abundant and speculative appetite was high, Bitcoin ripped upward. When rates rose and liquidity tightened, it sold off aggressively, acting exactly like a highly volatile tech stock.
But then at other times, we see it act completely differently.
In other windows, particularly during regional banking crises like the collapse of Silicon Valley Bank or moments of severe sovereign distrust, the correlation breaks entirely. It detaches from tech stocks and begins to trade much more like a non-sovereign monetary alternative.
So it starts acting like gold.
Exactly. It catches a massive bid as people flee counterparty risk in the banking sector.
Is it an inflation hedge or not? People get so mad about this on financial TV. They scream, inflation printed at 8% this month and Bitcoin went down 10%. It's a failed hedge.
This requires a much longer time horizon to understand. Over a long, multi-year ideological horizon, yes, it functions as a highly effective hedge against fiat currency debasement because of its hard mathematical supply cap.
Month to month.
Over short-term market horizons, month to month or quarter to quarter, it is an absolutely terrible hedge against the consumer price index. In the short term, its fiat price is far more influenced by leveraged trading, macro market sentiment, regulatory news, and adoption cycles than it is by the price of milk or gasoline at the grocery store.
The volatility is just the reality of the asset right now. It's an adolescent technology.
Volatility is not a bug. It is an inherent feature of its ongoing monetization process. You are watching an entirely new asset class discover its price in real time globally, 24 hours a day, 7 days a week, with the perfectly inelastic fixed supply and incredibly fluctuating human demand.
Basic economics.
Basic economics dictates that if supply cannot adjust to meet demand, the price has to absorb all the volatility. Of course it is going to be volatile.
Speaking of discovering its price, let's talk about the actual market plumbing. Because the price of Bitcoin isn't handed down by some central oracle on a mountaintop. How does the market actually figure out what one Bitcoin is worth in dollars on any given Tuesday?
The price is discovered across a highly fragmented global patchwork of trading venues. You have centralized spot exchanges like Coinbase or Binance, where retail users and institutions trade actual Bitcoin via open order books. You have massive over-the-counter or OTC desks, where whales and institutions execute block trades directly with each other to avoid moving the open market price. And crucially, you have deep derivatives, markets, futures, and options venues, where traders use massive leverage to speculate and hedge their positions.
The text highlights a massive irony here. The entire cypherpunk point of Bitcoin was to completely eliminate trusted intermediaries. Yet, to trade it efficiently, millions of people use centralized exchanges.
It is the great structural paradox of the ecosystem. The base layer protocol was engineered specifically at great computational cost to remove counterparty risk. But for the sake of simple user convenience and deep trading liquidity, millions of users voluntarily reintroduce that exact same trust by handing their funds over to a centralized exchange corporation.
Just giving them the keys.
Yes. If you hold your Bitcoin on an exchange and that exchange goes bankrupt, gets hacked, or is ordered by a government to freeze withdrawals, the underlying Bitcoin protocol is still functioning perfectly, but you have lost your money.
Which is the perfect segue to the recent game-changer spot ETFs. The approval of these in traditional finance was a massive watershed moment. How did ETFs fundamentally change the landscape?
ETFs fundamentally change access. They did not change the protocol. A spot ETF allows traditional investors to get direct fiat price exposure to Bitcoin within their existing comfortable brokerage accounts, their 401k retirement accounts, or massive institutional mandates.
So my parents can just buy it like a stock.
Exactly. They don't have to download a cryptographic wallet, they don't have to worry about securing a private key on a piece of paper, and they don't have to navigate an offshore crypto exchange. It removed an enormous amount of operational friction for traditional capital.
But there is a massive philosophical trade-off.
An existential trade-off. When you buy the ETF, you do not own Bitcoin. You own legal shares in a highly regulated fund structure, which in turn holds the actual Bitcoin at a centralized institutional custodian.
So you have the price, but not the control.
You have clean price exposure, but you have absolutely zero sovereign control. You cannot send that Bitcoin to someone else on a Sunday night. You cannot use it to avoid capital controls if your government decides to lock down the banks.
It's the ultimate Wall Street financialization of the asset, which brings us to the core mantra of the space regarding custody.
Not your keys, not your coins.
Let's dive really deep into that, because holding Bitcoin seems to exist on a wide spectrum of risk. On one far end, you have pure self-custody.
Self-custody means you, and you alone, control the cryptographic private keys. Usually people use hardware wallets. These are small, specialized, secure devices that keep the keys completely offline, away from internet-connected malware on your laptop.
Right.
It represents the purest realization of the cypherpunk ethos. You are literally your own bank. You have absolutely zero counterparty risk.
Which sounds incredibly empowering, but
But you absorb 100% of the operational risk. If your house burns down and you lose your device, and you also lose the piece of paper with your backup seed phrase, nobody can help you. There is no password reset button. The responsibility is absolute and unforgiving.
Then there is a middle ground that institutions and wealthy individuals use, right? Multi-sig.
Multi-signature wallets. This is a script where you might require, say, 2 out of 3 distinct private keys to authorize a transaction. You could hold one key on a device in a safety deposit box, one key on a device hidden in your home, and give the third key to a trusted security company.
Oh, that makes a lot of sense.
It eliminates the single point of failure. If a thief breaks into your house and steals one key, they still can't move the funds because they need a second signature.
And then on the far end of the spectrum is pure custodial storage.
Holding it on a centralized exchange or with an institutional custodian, it is highly convenient, and for many regulated funds, it is actually legally required. But it concentrates massive amounts of wealth in decentralized honeypots.
So you're back to trusting a bank.
If we connect this to the bigger picture, if someone else holds the keys, you only have a legal claim to the asset, not cryptographic ownership. If the state orders the custodian to freeze your account, your funds are frozen just like a bank account.
With the advent of these ETFs and massive institutional custodians holding literally tens of billions of dollars worth of Bitcoin, it is incredibly obvious that this is no longer just a weird cryptography experiment for internet nerds. It has hit the absolute big leagues of global finance. Who are the actual players driving this massive market today, and what do they actually want from it?
We have to break down the user base because different actors are playing entirely different games on the exact same board. Let's start with investors, because even within that specific category, there's a massive spectrum of motives.
The retail investor buying $100 a week is totally different from the hedge fund deploying $1 billion.
Completely different. At the retail level, you have a mix of true, die-hard ideological believers who are treating it as a long-term savings technology, completely outside the fiat system. But you also have pure momentum traders, people who don't care about the ideology and are just trying to ride the extreme volatility to make a quick buck.
What about the larger pools of capital? Family offices, high net worth individuals?
For them, Bitcoin is often viewed as an asymmetric macro asset. It is an asset with a potentially massive upside that is historically uncorrelated with traditional equity earnings or bond yields. So they might take a very small allocation, say 1% to 3% of their portfolio, just for portfolio diversification.
It's just a math equation for them.
If the asset goes to zero, the broader portfolio easily survives. If it goes up 10x, it meaningfully drives the overall returns. They might not care about the cypherpunk ideology of decentralization at all. It's strictly a mathematical portfolio construction strategy.
And then you have the hedge funds. I hear all the time about hedge funds doing basis trades with Bitcoin. What does that actually mean mechanically?
Hedge funds are incredibly pragmatic. They aren't in it for the religion. A basis trade exploits the price difference between the current spot price of Bitcoin and the price of a future contract.
Okay, wait, explain that a bit more.
Often, because speculation is so high, a futures contract expiring in 6 months might trade at a massive premium to the spot price today. A hedge fund will buy the actual spot Bitcoin and simultaneously short the futures contract.
So they lock in the difference?
They lock in that price difference, the basis, as a risk-free yield. They're literally just harvesting market inefficiency. They don't care if Bitcoin goes to $1 million or $10. They're just extracting yield from the volatility.
So that's the investment side. Let's pivot to businesses. For years, the mainstream narrative was always, when will I be able to buy a cup of coffee with Bitcoin? People thought business adoption meant using it as everyday, circulating cash. But the reality is quite different.
The business reality splits into 2 completely separate functions: payments and treasury strategy. On the payment side, yes, some merchants accept it, but usually they use a payment processor that instantly converts the Bitcoin into dollars or euros at the exact point of sale.
Because the coffee shop has to pay commercial rent and buy coffee beans from their suppliers in dollars, they simply can't afford the volatility of holding Bitcoin on their books.
Exactly. They are just using the Bitcoin network as a payment rail to acquire fiat currency. It expands their customer base to crypto holders, but it isn't true monetary adoption at the operating cash flow level.
But the treasury strategy is where it gets totally wild. Companies actually putting Bitcoin on their corporate balance sheets. MicroStrategy is the famous example, holding billions of dollars worth, but others do it too. Why would a publicly traded company hold a volatile asset instead of cash or government bonds?
Several distinct reasons. Some CEOs view it as a necessary corporate hedge against long-term fiat inflation, believing their cash reserves are melting away in purchasing power. Some use it as a highly speculative capital allocation strategy, essentially transforming the company's balance sheet into a levered Bitcoin investment vehicle for traditional investors. But holding it as a long-term reserve asset is fundamentally different from using it to run your daily operations. It creates massive shareholder enthusiasm during a bull market and severe, sometimes existential stress during a massive 70% drawdown.
And let's not forget the businesses that literally only exist because of Bitcoin.
The ecosystem businesses, the massive mining hardware manufacturers in Asia, the huge exchange platforms like Coinbase, the chain analytics firms that trace transactions for law enforcement, the specialized custody providers.
It's a whole industry.
For them, Bitcoin isn't just an asset on a balance sheet. It is their entire industrial substrate. Their entire business model depends on the network functioning perfectly, block after block.
Which brings us to the final and most fascinating institutional player governments. The expert manuscript highlights that governments have the ultimate contradictory relationship with this technology.
It is a profound contradiction that is playing out in real time. Let's look at how a typical Western nation-state interacts with Bitcoin. First, they try to regulate the access points. They know they can't regulate the math of the protocol itself, so they heavily regulate the centralized exchanges.
Right.
They impose strict anti-money laundering and know-your-customer laws on the on-ramps and off-ramps where fiat currency touches the crypto ecosystem.
Then they tax it.
Heavily. In most jurisdictions, it is treated as property for tax purposes, not as currency. Every single time you sell it or spend it to buy a cup of coffee, it is a taxable event, subject to capital gains reporting. This practically kills its use as an everyday medium of exchange in those countries because the accounting overhead for the user is an absolute nightmare.
But here is the ultimate irony. As law enforcement agencies bust criminals, hackers, and dark web marketplaces, they seize the assets.
They seize the physical hardware and extract the private keys. And because the asset has appreciated so massively, governments that were initially total skeptics or hostile observers have inadvertently become some of the largest holders of Bitcoin in the world.
So the U.S. government, the German government, they literally hold billions in Bitcoin on their balance sheets strictly because of criminal seizures.
And this sparks incredible debates internally. What do they do with it? Do they auction it off to the public to raise fiat revenue? Or, and this is where macro geopolitics enters the chat, do they start viewing it as a strategic reserve asset?
Wow.
Some policymakers view Bitcoin as a direct threat to sovereign monetary control, a tool for capital flight. Others view it as a strategic necessity. They see a future where nations might stockpile it the same way they stockpile gold reserves, fearing that if they don't, rival nations will gain an asymmetric economic advantage.
That is wild. The government is regulating it, taxing it, seizing it, and potentially hoarding it all at the exact same time. But as Bitcoin scales up to this sovereign level, as ETFs pour billions into the space, the target on its back grows exponentially. What happens when this machine is put under extreme stress? What are the legitimate critiques?
It's vital to separate the real existential risks from the imagined or misunderstood ones. The critics and the proponents often talk right past each other.
The manuscript draws a hard line between protocol risk and ecosystem risk. Let's start with protocol risk. What is the most realistic existential threat to the core software? The 51% attack is the one that always comes up in debates.
The 51% attack is a theoretical scenario where a single entity or a colluding cartel of mining pools manages to gain control of more than half of the total mining hash power on the global network.
If they do that, if they control the majority of the computing power, can they just print 1 million new Bitcoins for themselves and steal my private keys?
No, that is a very common myth. Even with 51% or even 90% of the hash power, the attacker cannot violate the fundamental consensus rules without the independent nodes rejecting their blocks. They cannot mathematically create coins out of thin air beyond the block subsidy, and they absolutely cannot forge your digital cryptographic signature to steal your funds. Your keys are safe.
So what can they actually do with that majority power to hurt the network?
What they can do is reorganize the recent history of the ledger. Because the network is programmed to always follow the longest chain with the most accumulated proof of work, an attacker with 51% power could quietly mine a longer parallel chain in secret.
Okay, so a fake history.
They could spend their own coins on the public chain to buy goods, and then suddenly broadcast their secret longer chain to the network. The nodes would accept the longer chain as the truth, reversing the attacker's original transaction, effectively allowing them to double spend their money.
And they could censor people, right?
Yes, they could also refuse to process certain transactions, effectively censoring targeted individuals. While they can't break the cryptography, a sustained 51% attack would shatter the market's confidence in the network's settlement finality, which would likely crash the fiat value of the asset.
Which is why the concentration of mining power is a real structural fragility. If 3 massive mining pools suddenly decided to collude, or if an authoritarian government forced them to at gunpoint, that's a massive problem.
It is a genuine vulnerability. Geographic distribution and decentralization of the physical mining infrastructure are critical, ongoing defenses against it.
Another long-term protocol risk mentioned is the transition to a fee market.
Remember the halving schedule we discussed. Eventually, the block subsidy, the newly minted coins given to miners, will drop to zero in the year 2140, but it will drop to negligible amounts long before then.
Right, so how do miners make money?
At that point, the miner's only revenue to pay for electricity and secure the network will be the transaction fees paid by users. If the network isn't generating enough fee revenue in the future, the security budget drops, hash rate falls, and the network becomes much cheaper and easier to 51% attack. It is a serious, long-horizon economic design question that the community still vigorously debates.
So that's the base layer protocol. But the text argues that the vast majority of historical failures in crypto aren't protocol risks at all. They are ecosystem risks.
The software protocol is remarkably robust. It has essentially 100% uptime since its inception. But the human layer built around it fails spectacularly and constantly. We are talking about massive centralized exchange collapses, like Mt. Gox in the early days or FTX recently.
Oh man, FTX.
We are talking about elaborate phishing scams, fraudulent centralized yield platforms that operate like Ponzi schemes, and simple user errors where people accidentally throw away their seed phrases. The decentralized machine works perfectly, but the centralized human institutions operating in the interfaces do not.
This brings us to the most contentious, heavily debated topic of all environmental impact. Does Bitcoin boil the oceans?
The source material takes a very serious, balanced analytical posture on this, because it is where technical realities, economic incentives, and moral arguments collide head-on. As we discussed, Bitcoin uses a massive amount of electricity to power the hashing algorithm. That is an undeniable physical fact.
But the text is clear. It's not accidental waste. It's not inefficient coding.
Critics look at the sheer energy consumption and say it is an ecological disaster that could easily be replaced by a more efficient, centralized database or a different consensus mechanism. They argue it externalizes severe environmental costs onto society purely for the benefit of financial speculators.
What do the proponents argue back?
Supporters counter that the energy use is the exact mechanism that secures the network. It is the unforgeable physical cost of creating politically neutral, censorship-resistant money. They also point to the economic reality that Bitcoin miners are highly mobile and incentivized to seek out the cheapest possible power. This often leads them to utilize stranded energy hydroelectric power generated in remote locations that cannot physically reach a major city grid.
So energy that would otherwise just be wasted.
Exactly. They also monetize flared methane gas at remote oil wells, turning a severe greenhouse emission into computation. Furthermore, they act as flexible load balancers for renewable energy grids, shutting off their machines instantly when consumer demand spikes, stabilizing the grid economics.
They see it as an energy grid optimizer, while critics see it as a parasite.
The reality is that both dynamics occur depending on the specific geographic location and the power operator.
Okay.
But the ultimate disagreement here isn't really about engineering or megawatts. It is a deeply philosophical debate.
Right.
Is the existence of a globally accessible, politically neutral, non-state monetary asset worth the physical, real-world cost required to secure it? If you think Bitcoin is useless speculation, any energy use is a tragic waste. If you think it is a vital lifeboat for global financial sovereignty, the energy is a necessary, justifiable defense budget.
That is a phenomenal way to frame it. Another major critique we have to address is illicit finance. The common refrain is, it's just for drug dealers, ransomware hackers, and money launderers.
Yes, it is used by criminals. But so is physical cash, and so is the traditional regulated banking system. The text highlights a crucial counterintuitive point because the Bitcoin ledger is completely public and immutable. Law enforcement actually has immense forensic visibility.
They could see everything.
Chain analysis companies can track illicit funds across the globe, hopping from wallet to wallet, in ways they could never do with suitcases of physical cash or complex offshore shell companies. The analytical mistake is jumping from the fact that it is used in some crime to the conclusion that it is primarily for crime. The empirical data simply doesn't support that leap.
Before we bring this all together, we need to contextualize Bitcoin within the broader crypto landscape. If Bitcoin is the baseline, what is all the other stuff? There are thousands of other crypto assets out there. Are they all trying to do the exact same thing?
Not at all. And confusing them as interchangeable is a massive analytical error that mainstream commentators make constantly. Bitcoin is heavily optimized for conservative, hard monetary settlement. It rigidly prioritizes security, backward compatibility, and decentralization above speed and complex features.
What about Ethereum? That's the second biggest by market cap.
Ethereum optimizes for programmable state transitions. It is designed to be a decentralized execution environment for smart contracts and decentralized applications. It intentionally trades off some of Bitcoin's simplicity and monetary purity to achieve massive programmatic flexibility. It is Turing complete, allowing developers to build complex financial Lego blocks on top of it.
And Solana.
Solana focuses almost entirely on consumer-facing speed, massive transaction throughput, and incredibly low costs. It aims to be the high-performance engine for decentralized finance and applications. But achieving that immense speed usually involves different assumptions around hardware requirements and sacrifices some of the extreme decentralization that Bitcoin insists upon.
Stablecoins are incredibly important to mention here, too.
Arguably the most important sector in the space next to Bitcoin. Stablecoins like Tether or USDC are tokenized liabilities designed to perfectly track the value of fiat currencies, primarily the US dollar.
So they are volatile.
Right. They are not meant to be scarce or volatile. They are the highly efficient 247 transactional rails that grease the wheels of the entire global crypto economy. They provide dollar access to people in developing nations who can't open a U.S. bank account.
The text also briefly touches on others to show the variety. XRP for enterprise cross-border settlement narratives, BNB as an exchange-linked ecosystem token, Monero optimizing completely for transaction privacy, hiding amounts and addresses, and even Dogecoin, which started purely as a joke but proved that internet culture, narrative, and celebrity attention can sustain actual multi-billion-dollar financial value.
Seeing Bitcoin mapped against these specific alternatives clarifies exactly what its narrow mission is. It is not trying to be the fastest payment app or a complex world computer or a stable dollar substitute. It is trying to be the hardest, most uncompromised monetary base layer in the world.
We have gone through the cryptography, the mining engine, the economics, the institutional adoption, and the risks. Let's pull all these threads together to see what this network is ultimately becoming.
When you synthesize this entire journey, you see that Bitcoin is evolving into several distinct, massive things all at once. For individuals in distressed economies, it is a vital savings technology, a way to preserve wealth outside the reach of hyperinflation or authoritarian capital controls.
And for institutions.
For Wall Street, it is a new macro asset class and a highly regulated financial product wrapped in ETFs. For the plumbing of the crypto economy, it is pristine collateral. And for governments, it is rapidly transitioning from an internet curiosity into a strategic geopolitical object.
It is a protocol, a ledger, a scarce asset, a massive security budget, and a profound political challenge, all rolled into one. And that is why we did this deep dive for you today. Because whether you are a retail investor trying to decide how to allocate your portfolio, a skeptic who thinks that energy use is insane, or just someone who is insanely curious about how the modern world is being rewired under our feet, you cannot ignore this anymore.
You now understand the actual mechanics of the machine, not just the media slogans. You know why the price moves based on liquidity and adoption, how the supply is mathematically constrained by the difficulty adjustment and the halvings, and why massive institutions are fundamentally being forced to pay attention to it.
As we close out, I want to leave you with one final lingering thought to mull over. We've spent an hour talking about how this machine survives technical attacks, how it weathers brutal market crashes, and how it navigates regulatory crackdowns.
This raises an important question. If we project this forward, consider the ultimate implication. If Bitcoin fully succeeds in its core mission, it proves definitively that a monetary asset can exist and command massive global reserve value, entirely outside of sovereign state issuance and corporate liability.
Think about that. What does that do to the fundamental power structure of the nation-state? When the ultimate lever of power, the ability to print and control the supply of money, suddenly has a globally accessible, uninflatable, mathematically enforced, and utterly indifferent competitor.
It redefines the relationship between the state and the wealth of its citizens.
Because at the end of the day, you can keep looking at the sleek glass of your smartphone and ignore the transistors. But the gears of this particular machine are already turning, and they are not waiting for anyone's permission.